The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
So it is Thursday, 26th of September. It's great to have Jeremy back as ever. And this week we're joined also by Alistair Stewart, our building construction analyst, who's got a couple of comments on the house building sector and more broadly. So welcome both of you back to the podcast.
Thank you.
Good to chat. So Jeremy, what have you seen on the broader macro horizon this week?
I think the headlines in the last couple of days have been probably around China, around various packages of stimulus measures that have been introduced quite quickly and unexpectedly by the PBOC and other authorities in China, which have included such things as schemes to allow brokerages to tap central bank funding to buy equities, lower mortgage down payments for people wishing to buy second homes, and more funding available for local government-owned enterprises to help them purchase unsold inventory from property developers. So it boosted the Chinese stock market on Tuesday by about 3.6% and provided a value bump elsewhere in the world for Chinese proxies, such as luxury goods companies. But I think on a bit of reflection, one might just consider the extreme measures that the examples of which I outlined just now actually involve. It possibly highlights the extent to which these policymakers must be concerned about the prospect for the Chinese economy and for its mandated requirement to grow the economy at 5% per annum. Then overnight last night, we got further indications that the Chinese authorities are prepared to use fiscal measures for the first time to stimulate economic activity in the form of helicopter money. While the markets are enjoying the sugar rush of these measures, I think on reflection, these could actually indicate some other worries and concerns that might be going on in China.
It certainly feels like they're doing some things there which you wouldn't necessarily think would be natural for them. So yeah, maybe they are worried about the perils that still underlie the Chinese economy. So it'll be interesting to see how that evolves. But okay, what about more broadly?
Things haven't really changed. The dollar has continued to weaken a bit. The pound has strengthened and precious metals have continued their structural advance to new all-time highs, so gold, silver particularly. But the outlier in all this is oil. We've had indications today that oil is not what the Saudis were targeting by way of keeping production tight in order to reach their ideal target of $100 oil prices. Now, we're a long way off that $100. We've seen weakness in the oil price, which some people would point to from a demand side as being indicative of an underlying weak global economy. Now, we know the US economy is showing signs of slowing down, but if we've got China in more troubled times, then this could lead to much weaker oil prices from here, potentially.
Okay, and how about closer to home? What have we had in terms of the UK over the last few days?
Obviously, news has been dominated by the output from the Labour Party conference in Liverpool. And I think it's quite clear all week that Reeves and her party colleagues have been put on notice to cheer up and that they're signalling a change of tone around the opportunities that economic recovery and growth in the UK economy and confidence in the UK economy can deliver. The other factor that we've had, which I think is helpful, that the OECD have now quite overtly swung behind the UK government in endorsing the suggestion that UK borrowing rules should be adjusted to allow for public investment, and particularly regarding the green transition that the Labour government is so keen to push the button on. These are measures that are trying to take the pressure off the idea that the October budget is just going to be bad news for the UK economy. And I think we've been softened up sufficiently to know it's not going to be great news. But I suspect we've also been delivered in typical fashion the bad news up front, so that when she lifts the rabbits out of the hat at the end of October, we'll be able to breathe a bit of a sigh of relief, perhaps.
Yeah, so we've got just over a month till that budget, and it sounds like they're certainly doing all they can to try and stretch the rules around borrowing. So yeah, maybe the medicine won't be quite as painful as we've been led to believe.
Yeah, and the factor that sort of would support that view is that the 10-year gilt yield has ticked up all week, and it's heading to a new sort of 4% handle as well.
Okay, interesting. And a lot of the news, as you say, is dominated from the Labour Party conference. And one of the big themes that Labour have been espousing for a number of months, both pre and now post the election, is house building. And so we thought it'd be good to have Alistair Stewart, our building and construction analyst, back on the podcast to talk about how you're seeing the house building landscape writ large, or the construction landscape overall. And then in the last few days, we've also had the insolvency of ISG, one of the larger contractor groups out there. So it'd be interesting to hear what you think the impacts of that might be across the industry and a bit more broadly. So Alistair, what are you seeing?
Sure. First of all, I think some of the doom-mongering talk, really only over the last month or so, has actually had a dampening effect on house buyer confidence. House buying's probably one of the key indicators of economic health, certainly in the consumer market. In a bit of a rarity, the market actually was quite stable over the summer months when most people go on holiday. Usually there's a dip, but various house builders, including our own Springfield Properties, have said the demand kept ticking away quite nicely. However, just really in the last month, various house builders have told me that sentiment started to get dented. So September, when there's usually a big uptick, was a bit muted. Maybe it'll come back, and maybe when the Prime Minister and Chancellor start being more upbeat, that may improve. Definitely the demand's there. Affordability is improving. So I remain bullish on housing and house building, but there certainly has been a bit of a wobble.
And Alistair, talk to us about ISG, because it's got a few headlines, and we've had collapses of contractors before, which have been quite substantial in terms of their impact. So it'd be interesting to hear your early views on what you're seeing and what you think that might mean more broadly across the industry.
Well, ISG has gone into administration, not insolvency. It is a big blow to parts of the industry. It's the biggest company failure since Carillion. Politically, I think it's really quite consequential. Two of their main areas were in prison refurbishment and also building new schools. Now, when a major part of the supply chain fails, the jobs have to be retendered, often under very different terms, more expensive terms, with risk being passed to the customer. But in the meantime, there could be months of delays, maybe even years of delays on some of these public projects. So that's something that government may have to consider, especially on the prison building side of things. The other big impact is on the supply chain. There's talk about tens, maybe hundreds of millions of funds being owed. Fortunately, Van El, one of our companies today, said their exposure was less than £100,000, but there could be a domino effect of one subcontractor goes bust on that job, but they'll be bust on 24 other jobs. That can hold up the project. Then other people don't pay. So it can actually become quite a fast breeder impact across the industry.
Do you think there's a possibility somebody might step in and pick up the group from administration? It's not impossible.
Very unlikely. The Texan family office that bought them in the first place had overextended themselves. But the work will all eventually be done. The staff are very much in demand. There's a real skill shortage at middle management level, more so than bricklayer level across the industry. But it's a big lesson for government and private sector clients. You get what you pay for.
Yeah. As I say, hopefully the impact won't be too bad, and those projects can get back on track and the industry can work its way through. But yeah, a challenging outlook for some areas of that. Well, thank you very much for that, Alistair. Good to catch up and good to hear your views on both the sector and the ISG impact.
You're welcome.
Turning to the UK, We had updates from Zoo Digital, Van L, IG Design Group, Turn, and Oxford Metrics just in the last 7 days. And generally, the news, I think, has been pretty upbeat, a number of positive themes and comments coming through. There is one theme, though, that's a bit more cautious, which is companies which have a higher level of exposure to overseas market, in particular the States, are seeing things as a little bit more challenging. We saw that both from IG Design and from Oxford Metrics. They're both very international in their businesses, and they've both seen ongoing pressure or challenges in terms of their end market. So there is a little bit of a theme that, Jeremy, you and I have been discussing for a couple of weeks now, that the US isn't perhaps as buoyant and dynamic as investors have normally expected it to be.
Yeah, there's lots of comments out there more broadly on these RNSs where people are just saying, even if they've got figures that are okay, they're just pointing out that decision cycles, sales cycles are moving out. And typically that is the situation coming from US customers. But if you combine that with a weakening dollar or a strengthening pound, if you're reporting in sterling, these things mount up quite quickly. So I think the second half of this year is going to be featured with this sort of concern, I think.
No, absolutely agreed. And I think one thing that analysts aren't great at is recalibrating forecasts for changing exchange rates. We tend to just wait and see what happens, or wait for the companies to remind us that, for example, the dollar has declined, so that there might be some negative surprises from a number of companies across the market as they retranslate their US earnings.
Yeah, and I think in the worst cases, you've got finance directors and corporate treasurers who are sitting in the dark as well.
Yes.
I think, unfortunately, you do sometimes see whether you've got two or more layers of people not really focusing on this.
Yeah, that's probably right. But the truth will out. And just back on the progressive client list this week, we also had, actually from Alistair, the initiation of coverage on microcap business Nexus Infrastructure. It's focused very much on the house building sector and providing engineering services, in particular around earthworks and foundations, so sort of early stage in terms of that house building process. But a nice note from Alistair, and it'll be interesting to see how Nexus ride that wave, as we've been describing, of the government's focus on pushing house building. So hopefully they're exposed to some positive trends over the medium term. So I think that's probably it in terms of UK. Jeremy, what do you think we've got to look forward to next week?
Well, I think China's going to remain in the spotlight. On Monday, we get the release of some manufacturing PMI data. Manufacturing in China is clearly critical, not just for the Chinese economy, but for the global economy. And the data, it's been struggling to get above the 50 level for most of this year, in fact. And I think that given the awareness that the Chinese authorities with their stimulus packages this week have put on China, I think a weak PMI figure next week could be very consequential over investor sentiment broadly. We've also got inflation data next week from the EU, which is expected to show a continuing monthly figure of around 2.2%. And of course, it's jobs week in the States. We've got the crapshoot that is the non-farm payrolls coming on Friday. Last month's new jobs number was considered to be a weak figure at 142,000. This time, the expectation is for 130,000 new jobs, so that is an even weaker figure. And I think if we get a sharply lower figure than that, then I think you get a classic case of bad news is good news, because that'll mean we'll get sharper falls in US dollar interest rates for the remainder of this year. And for the time being, at least, that is what the stock market will take as good news.
So if the jobs number's weak, then expectations around the US rates would decline, which is probably good news for US equities. Would that also potentially mean the dollar might decline further, though? So it just continue the trends that we've talked about?
Yes, in theory. I think the risk to the dollar is now to the downside. And the consequences of that for the UK are broadly positive.
Okay, well, let's see what that data brings next week. Jeremy, Alistair, thank you very much. Great to have you both back. And Jeremy will speak this time next week.
Yeah.
See you then.
Thank you.
Thank you.
Bye-bye.
Cheers.
Brought to you by Progressive Equity.